Alright guys, what's going on? Grab a pen and jot this down. Today we're going to talk about discounted cash flow statements, why they're important, what you need to focus on, and how it impacts your investment portfolio. First up, what is DCF? How does a discount rate impact an investment? DCFs are a way to basically discount future cash flows into the present value and determine what the value of the investment is today. So, if you have $5 and over the life of the next 5 years, you decide to get $1 every year, then you don't have a $10 investment. You have a discount what $1 would be in year 1, 2, 3, 4, and 5. And over the lifespan of the yield curve, interest rates increase over time, or they should be. Sometimes they get inverted, or something else happens, like the Federal Reserve decides to get involved and make an impact. So the dollar that's worth in year 5 is actually worth less today because you have to wait 5 years for it to compound. So if you have $5 that's invested and you think you're going to make another $5 of interest spread out over 5 years, depending on your interest rate, you're going to have to discount every year accordingly. So there are formulas to this. It's a very simple formula. You can look it up, the net present value. And then you say, all right, 10% rate means in 1 year, it's worth 90 cents today, and then you do it again for year 2, and then year 3, year 4, and beyond. And I said 10% for a specific reason because guys like Warren Buffett and Bill Ackman and very, very sophisticated value investors, they use a very simple model, and they don't really look at the risk-free rate, which is known as treasury rate, which might be 2% today, 4% tomorrow. It was 0% for many years. They look at what they think the arbitrary number or the hurdle rate for equity investments are. And in their mind, 10% is a good baseline. It's their benchmark. They want to deliver a minimum 10% on all their investments, meaning that's the cost of their capital. And then they target a return on that equity above that. So they have a very high level of margin safety. So they're really targeting 20 to 30% plus. So they say, all right, I'm going to use 10% as my hurdle rate, and I'm going to use that as a discount rate. And it has such a high level of margin of safety, even for a very, very good company like a Starbucks or Johnson & Johnson, it's fine for them because they're going to say, all right, if I'm pricing in my errors or my mistakes, then 10% is a good enough starting number to get me going and make the investment today. And then if there's some changes, maybe interest rates will be 20% or 15% like they were in the 70s and 80s, then you just change your discount rate accordingly. But they don't do anything sophisticated with Excel models. They go straight in, draw it on a piece of napkin, and say the stock that's worth maybe $100 in 10 years, maybe it's worth $52 today or whatever. And the reason that market prices change all the time is I might be using a discount rate of 8%. You might be using it at 12, and then Buffett's using it at 10. And we misprice these securities because I think it might be worth more. You might think it's worth less. And then you kind of wait for the market to adjust to a price where you think you're going to buy or sell, depending on how things change in the world. So that's a quick wrap up on what DCFs are. More to come, more detailed definitions on this, and how to do this for other forms of cash flows, and understand how this may impact things as expenses and revenues change as you change financing and operations of cash flows, and then how you invest those cash flows also changes how the value of a company is worth today.